let's do an introduction to Nadex knockouts and call spreads. And I'd like to remind you, if you've got any questions, there's that question mark on the right-hand side of the page. Type in your questions. I'll do my best to answer them. I'll try as we go. If I don't get to them, I will try to take a peek at the end. If I miss any of your questions, I promise you that someone will follow up with you to make sure that you get an answer to your question. Once again, the disclaimer, you're going to see this at every one of the presentations today, that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And please don't take anything anyone says today as a buy or sell recommendation. We are doing this for your education purposes. That'll become abundantly more clear too when I jump over to the platform and I do a little bit of a demonstration. So what are we going to cover in this session? One, I'm going to start with knockouts, and I'm probably going to spend more time with knockouts than I am with call spreads, because once you understand knockouts, call spreads are very easy to understand. I am going to talk about how they work. I'm going to talk about risk reward, and then the capital requirements, and that'll also help you understand why we offer knockouts the way that we do. Then I'll get into call spreads, and then it's a practical demonstration, and you'll be able to see how you can identify different knockouts and different call spreads on the Nadex platform, trying to look for potential trading opportunities. Again, we're talking about short-term trading opportunities, day trading, whether it's in the next couple hours, whether it's today, whether it's by the end of the week. I mean, relatively short term, there are trading opportunities. And just like with binary options, you've got knockouts and you've got call spreads. So let's define a knockout first. And it's a contract, and a knockout, the nature of the knockout, it defines a contract with a set price range. There is a price range, and that price range is set by two levels. We've got a floor, which is the lower price level, and we've got a ceiling, which is the higher price level. And the value of the contract is going to trade directly in line with the underlying market between the floor and the ceiling. A knockout is what we like to refer to as a Delta 1 product. So if you've heard of that term, and the reason I say it's a Delta 1 product, unlike a binary option where you're trading the probability of the event being true or not, when you're trading a knockout, you're actually trading the price of the underlying. So I am going to use oil as an example. If oil's trading around $71.25 a barrel, the price of the knockout will be $71.25. It is going to move directly in line. In fact, that's what you're trading. You're trading the actual price of the underlying. To me, I think that's the most intuitive. And just like any other market, if you think the price are going higher, you would buy it. And if you think the price were going lower, you would sell it. Now, some people say, how can you sell something you don't own? And that's why it's a contract. You're actually not selling the physical product. You're trading a contract, which is the price of the underlying product. So if I think the S&P 500 were going higher, I can buy a knockout looking for the price to go higher. If I thought oil were going lower, I can sell it. I'm taking a short position on oil, looking to profit if the price would go lower. So I am trading a Delta 1 product. I'm trading the price of the underlying. The price that you see that you're trading on the knockout is the price of the underlying. And then you've got these other prices around it, a floor and a ceiling. Now, how do knockouts work? And the way knockouts work is they can settle or expire in one of two ways, either by price or by time. So let's first talk about price, which is price-triggered settlement. If the underlying index for a particular market or a particular product at Nadex touches the floor or the ceiling, that contract immediately expires. It settles. So if it touches the floor or it touches the ceiling, it is a price-triggered settlement. The contract ends, and that's it. If you buy a knockout and you're wrong and it goes down and it touches the floor, you are out of your trade. You are knocked out of your trade. That's why they're called knockouts. You buy it, it goes down to the floor, you are knocked out, and you experienced maximum potential loss. Give me 1 second. Okay, now, if you happen to buy a knockout and it goes up and it touches the ceiling, you are also knocked out of your trade. You bought it, it went up to the ceiling, you got knocked out, and you experienced maximum potential profit. So you buy a knockout, if it goes down and touches the floor, you're knocked out. And it doesn't matter how much lower it goes, you're knocked out, you had maximum loss. If you buy it and it goes up and it hits the ceiling, it doesn't matter how much higher it goes, you cannot profit anymore, but you got knocked out for maximum potential profit. Now, it works the other way if you sell it. You can sell a knockout looking for the price to go lower. If you sell it and the price goes down to the floor, it touches the floor, you are knocked out and you got maximum potential profit. If it keeps going lower, you cannot make any more. If it bounces right back, it doesn't matter. You're already knocked out. You got maximum potential profit. Now that begets the question, what happens if it doesn't touch the floor or the ceiling? All right, and there will be a time when all knockouts end. Knockouts are set up as weekly contracts. And what happens is over the course of the week, the contracts will get knocked out, either because they touched the floor or the ceiling. And then if by the end of the week it hasn't touched the floor or the ceiling on a particular contract, there will be a time triggered settlement, at which point you will have experienced a partial profit or a partial loss. If you buy a knockout and it goes up, but it doesn't touch the ceiling, eventually it will settle at the end of the week and you would experience partial profit. Your profit would be the difference between the price you paid and where it settled. If it settled lower than where you bought it, you would have a partial loss. And it would be the exact opposite if you sold one. So a knockout, very clear, very simple. It is a defined risk reward contract. It is a Delta One product. You are trading the price of the underlying. If you think it's going up, you buy. If you think it's going down, you sell. And if it touches the floor or the ceiling, you're knocked out and you'll experience maximum potential profit or maximum potential loss, whether it touched the floor or the ceiling or whether you bought or you sold. And if it doesn't touch the floor or ceiling, it will expire at the end of the week. Now, we do have a maximum duration of 1 week, and we generally have 4 knockouts per market. Now, we've got knockouts on foreign exchange, we've got knockouts on equity indices, we've got knockouts on commodities. And so generally you will have 4 knockouts per market. And whenever one is knocked out, whether the floor or the ceiling is touched, we'll list a new one. So in general, in most market conditions, you'll have 4 different knockouts to constantly be choosing from. So let's walk through a simple example of how that works. I'm using gold as an example here. And at the time, we're assuming gold opens at $18.20 per ounce. And we list 4 knockouts. Now, you don't need to know the range of each one of these knockouts. You don't need to know the dollar value for each one of these knockouts. Because we'll show you on the platform. And by the way, and right away we're getting a question, are there indicators on the charts to help you choose? Yes. And in fact, I will go through that just like any other market, just like Mark Pietrino discussed earlier in the day. You can use technical analysis to analyze where you would want to get in and where you'd want to potentially get out, as well as help you choose which knockout you want. And the question also comes right away, can you get out of a knockout before expiration or a call spread? And the answer ahead of time is yes. We will discuss that too. In fact, that's rather important. But let's get into the knockouts. And here's the gold example. We have the price of gold at 18.20, and we create knockout number one, down $10 per ounce, up $40 per ounce. And so there's a 50-point range. And then we choose a knockout that has a slightly lower floor and a slightly lower ceiling until we've got 4 separate knockouts. So we've got 4 knockouts, and let's take a look at what happens when the price of gold moves. And here we've got gold at 18.20, and which is where we are. And this is the end of the week. All right. So the end of the week, we know that it will settle at some point. Now let's take a look at what happens if gold were starting to go higher from 18.20. As gold starts to go higher, notice that knockout number 4 has the lowest ceiling. Right? It has the lowest ceiling. And so as soon as it touches that ceiling, knockout number 4 is knocked out. All right. Anyone who had bought number 4 just made a little bit of a profit. They got knocked out. Anyone who had sold number 4 just experienced some loss. Number 4 is gone. And because it was trending higher, we'll add a new knockout a little higher so that you'll constantly have 4 knockouts to choose from. Now, let's take a look if it had gone the other way. If gold had started going down, knockout number 1 has the highest floor, right? So with the highest floor, knockout number 1 was the first one where the floor was touched. Knockout number 1 is gone. If you had bought knockout number 1 and it went down, it touched the floor, you just got knocked out for a loss. It doesn't matter how much lower it goes, you're out. All right, you're out. And if you had sold knockout number 1, you just made a little bit of a profit. But we're going to talk a little bit about that too on choosing knockouts. And notice because it went down, we add a new knockout below so that in general, you'll always have 4 knockouts to choose from. Now, as I mentioned, it's a variable payout in the end. It all depends on, for your profit and loss, it depends upon where you bought it or where you sold it. If it touches the floor or ceiling, that would indicate whether you had maximum potential profit or maximum potential loss. But in the event that it doesn't touch the floor or ceiling, it'll be the difference. Your profit or loss will be the difference between where you bought or sold it and where it settles in the end. So here's the same example, but at the end of the week, these were the last 4 knockouts that existed at the end of the week. And over the course of the week, they kept on knocking out different ranges. But at the end of the week, these 4 contracts existed. None of them had the floor or ceiling touched. So they were still in play, but then at the end of the week, it settles, and your profit or loss would be the difference between where you bought or sold and where it actually settled. Now, why do people like knockouts? And essentially, a knockout gives you a very defined, built-in trading plan. You know, before you get into a trade, what your maximum risk is, and you also know what your maximum potential reward could be before you enter the trade. So just like a binary option where you know it's going to go to 0 or 100, you know on a knockout, your best case scenario and your worst case scenario are the floor and the ceiling, and there is no slippage. There is no, once it touches one of those boundaries, once it touches the floor or the ceiling, that's the price. It settles at that price. It is over. The contract ends. So there is no placing an order to unwind your position. It simply settles, and that's it. And if you wanted to get back into the trade, you'd have to choose another knockout. So what you've got are natural profit targets with defined risk. The very structure of every knockout gives you a potential profit target and a stop loss level. So if you're buying a knockout, your stop loss is the floor. If you're buying a knockout, your profit target is the ceiling. And it's exactly the opposite if you're selling. Now, what's interesting is I'm getting questions about time decay on a knockout. And there is no time decay on a knockout. A knockout is a delta 1 product. Unlike binary options where there is some decay into it as they decay up to 100 or decay down to 0, and we're going to talk about call spreads next, but with knockouts, it is the price you're trading is the price of the underlying, and there's no decay. You're simply taking a directional play. It is a way for you to take a very distinct directional play with a profit target in mind and a stop loss built into your contract. If you sell a knockout, your stop loss is the ceiling. You sell it and you're wrong, it goes up. You know, it touches that ceiling. It doesn't matter how much higher it goes. You're knocked out. You can't lose anymore. Now, if it turns around and comes back down, unfortunately, you got knocked out. You got stopped out. Now, that also works in your favor for profit targets, right? And a lot of traders don't even think about that before they get into a trade. They just go, I think it's going up, and they might not have a profit goal in mind. But it's part of a trading plan. A trading plan should include not only how much are you willing to risk and managing your risk, which is absolutely critical, but it also should include a profit component to it as well. At what point would I be willing to take a profit if I'm right? And with a knockout, that is baked into the actual product itself. You've got this hard stop loss and this hard profit goal built in, whether you're buying or selling. Those levels are the floor and the ceiling. Now, what is your risk, right? What is your risk? Well, if you're buying a knockout, your risk is the difference between where you buy it and if it goes down to the floor where you would get knocked out. If you're selling, your risk is you sell it and it goes up to the ceiling. That is going to be the collateral that you put up for a trade. That is going to be what it costs you to do a knockout. Now, on the reward side, it goes in your favor, right? If I buy a knockout, my potential reward is the ceiling, and the profit. You know, what could I potentially make is the difference between where I buy it and the ceiling. And if I sell it, my potential reward is the difference between where I sell it and the floor. Now, we do those calculations for you on the order ticket, so you don't necessarily need to know the tick values. When you look at a knockout, it will show you very clearly where the floor and the ceiling are, and we'll calculate potential risk and potential reward before you get into a trade. That's one of the things that are that make knockouts very helpful. Now, I'm going to go through another example because I want you to visualize this on how you choose a knockout or why you might choose one knockout versus another. So here's the gold example again. And if I were looking to buy gold or go long the price of gold, right? I'm going long the price of gold, but I want to minimize my risk the most. You might choose knockout number one. Why knockout number one? That's because that's got the highest floor. So it's got essentially my tightest stop, right? I'm buying this. Knockout number one gives me the most run to the upside if I'm right, and gives me the tightest stop if I'm wrong. So let's take a look at this visually on knockout number one. I know here's where I'm entering the contract. I know the end of the week, it will settle at a price. And I know that I have a knockout. It's got a floor of 1810 and a ceiling of 1860. It gave me the range in the contract. Now, I knew it was at 1820. So when I bought this knockout, I know that my risk was just the red section below. I bought it at 1820. If it went down and touched the floor, 1810, that's what I stood to lose. That was the capital requirement for me to put on the trade. That is my risk. And what is my potential profit would be all the way up to the ceiling, at which point I couldn't make any more. What I'm showing you here is a very clear visual way for you to see the risk-reward ratio. With knockouts, this is one of the reasons why we offer 4 knockouts, is you can choose the risk reward ratio that suits you the best. So some people might be willing to take a little bit more risk and give up some of their upside. You might have chosen knockout number 2, where your red zone would be twice as big as it is right now, and your green would be a little bit less. You could see how your risk reward profile would change by choosing to buy a different knockout. Now, on the sell side, if I thought gold were going lower, I might choose knockout number 4. Now, why would I choose that? Because knockout number 4 has got the lowest ceiling. If I sell a knockout and it goes up and it touches the ceiling, that's where I get knocked out. I might want to give myself the tightest stop by having the lowest ceiling. So let's actually take a look at the same chart, but the other way around. If I thought gold were going lower and I wanted to sell it, I might have chosen knockout number 4, where I know it's at 1820. I'm selling it at 1820, right? Give me one second. Oops, sorry about that. All right, so I'm selling it at 1820. Now I know with that lower ceiling, I know that that's my risk. If it goes up and touches the ceiling, that's where I would get knocked out. Remember, I'm selling it here. Now you can see what my reward would be all the way down to the floor. Oop, that's not 1880. That should be 1780. I apologize. That's actually a correction that needs to be fixed. That's 1780 down at the bottom. A typo there. But you can see my risk reward. If I'm selling it, it's gonna. My risk is to the upside. My reward is to the downside. And again, I can choose the risk reward ratio that suits me the best. So that's number 1 on why we offer 4 knockouts. You getting to choose which risk reward ratio suits you the best. Now, the other is that since you know what your maximum risk is before you place the trade, that is going to be your capital requirement. You're going to have to put in your cost of the trade is your maximum potential loss when you place the trade. So and unlike other futures markets, once you've put the trade on and you've put up your maximum risk, there will never be a margin call. There are no margin calls at Nadex ever. You simply put up your initial capital requirement to do the trade, which is your maximum risk on the trade. So one of the other reasons that we offer, and it doesn't matter whether you're buying or selling, right? We know what your maximum risk is, whether you're buying or selling. So the other reason that we offer 4 different knockout ranges, it's not just to manage your risk reward ratio, but it's also for you to choose how you want to manage your trading capital. Because you can minimize your risk, you can choose the knockout with the lowest capital requirement so you can get the biggest bang for your buck with your trading capital. You can get into a knockout if you know there's only $50 of risk in the trade. It'll only cost you $50 to put on the trade. You can never lose more than that. Once you get into a knockout, that's what you put in, and that's the most you can lose, and there will never be a margin call. Now, if you get knocked out and for maximum loss, you're out of the trade. As long as you're not knocked out, you're still in the trade, and if it goes your way, you're still in the trade, and you can make a determination when you might want to exit that trade. Now, I am going to go through an order ticket very quickly. Here's an example of crude oil, where we've got a range, right? It's 66.25 to 71.25. I know where crude oil was at the moment in time. It was trading 70.62. I know there were 3 days left. I know there are 3 days left in this particular contract, and I've got a market, right? I've got a bid and an ask, and if I wanted to go short oil, I think oil were going lower, I could try to sell, right? And do I have to sell it at the bid? No, I can potentially offer my contract in between the bid-ask spread. Is someone necessarily going to trade with me? Not necessarily. But I can advertise my willingness to sell it at 70.61. And if anyone wanted to buy one, they would have to buy it from me first, because it's a first in, first out, first come, first served. You put your order in, and if someone wanted to buy it, they would have to buy it from you if you were the first one there. If I sold this contract at 70.61, I know the ceiling. I would get knocked out if it went up to 71.25. That is exactly 64 cents higher in oil. Now, we do the math for you, and the tick values of different contracts can be different. The spread, the width of the different contract knockout ranges can be different. We do the math for you on the order ticket. If I were to sell one at 70.61 and I got filled, I could not lose more than $64. I know that that is my maximum risk. That is what I would have to put up to do this trade, is I would have to put up $64. If it went up and touched 71.25, I would get knocked out and I would have lost my $64. But what could I potentially make? If oil dropped down to 66.25, I'm looking to potentially make $436. I'm risking $64 to potentially make $436 if it gets all the way down to the floor. Now, it does beget the question, do I have to wait until expiration to see what happens? And I will cover this again in a second, but the answer is no. If I sold a knockout and I know that I couldn't lose more than $64, but let's say it goes $100 in my favor, could I just buy it down at 69.61, a dollar lower, and take a $100 profit? Yes, I could. I will cover that in a second because I know those questions are coming in already. You can definitely exit the position early. Why would you do that? Lock in profits, minimize losses. Now, if you understand knockouts, call spreads are going to be rather intuitive. A call spread is also a contract that has a predefined range. Now, that range also has a floor and a ceiling. Sound familiar? It sounds an awful lot like a knockout so far. And the value of a call spread will move in line with the underlying, similar to knockouts, but not the same. Now, what makes call spreads different than knockouts? And call spreads are different than knockouts in two very important ways. All right, and those two ways, and this is important. Number one, a knockout will only expire at expiration. There is no price triggered settlement. That's very important. A call spread does not expire if it touches the floor or the ceiling. You are still in the trade if it touches the floor or the ceiling. That is important. So, and some people love that optionality. If I buy a call spread and it goes against me and goes down and touches the floor, I am not knocked out. I am still in the trade, and I have time for the contract to maybe come back in my favor and go higher. All right. Now, what's important is if I buy it and it goes through the floor, I'm not knocked out. But if it goes through the ceiling, I am also not knocked out. Now, if it goes up through the ceiling, I probably have experienced a rather significant amount of profit, but I'm still in the trade. It could turn around and go against me eventually. So that it's a double-edged sword. I am not knocked out with the call spread. I have optionality. If I sell a call spread and it goes up to the ceiling, I'm still in the trade, and I have time for it to turn around and go south. If I sell it and it goes through the floor, I'm still in the trade up until expiration. There is no price triggered settlement. Now, the other important component to call spreads is because there is that optionality baked into it, volatility and time to expiration will impact the price of a call spread. It will trade at a premium. So we got that question earlier about time decay with knockouts. There is none. but there is time decay on call spreads. All right, there is a premium in there, and the more volatile it is and the longer to expiration, that will impact how much premium is in that call spread. Now, in a call spread, the order ticket is very similar to a knockout. Here's an indicative price. Here's me trying to sell, all right, a crude oil contract, and this is really interesting. Currently, oil's at 70.60, and there's 18 hours to go. Now, I think oil's going lower, and so here's a call spread where the range is 65 to 70. We're already above. We're at 70.60. We're outside the range of this call spread, right? It's above 70. It's already at 70.60. I think it's going lower. Now, what's interesting, if I wanted to sell this, I'd have to sell it at around 69.70. You know, there's a bid right now at 69.67. Well, that's 27 cents or $27 below the ceiling of the contract. The contract ceiling is 70, right? That's actually 33 above it. Oh, that's because I have 69.73. I'm sorry. Notice the price. If I tried to sell one at 69.73 between the bid-ask spread, so I'm trying to sell at 69.73. Notice that's 27 cents or $27 below the ceiling. That's the premium, right? There's already a premium in this. I would have to sell this and put up $27 because I would sell it at 69.73. It could go to, it would settle at 70. I'm already above. And this is what people actually, they like call spreads. I'm only risking $27. I'm looking for oil to go lower in the next 18 hours. All right, now it's already up at 70.60. It would have to drop almost $1 before I'm at break even, because then it would be down at 69.60. It would have to drop like 90 cents for me to be, you know, just to break even. That's that premium. That's the premium I'm talking about. But I've got profit to the downside, but you've got very limited upside. If I were buying, if I thought oil were going higher, I might choose a contract where I'm buying near the floor, or maybe even a little bit below the floor. I'm going to have to pay a premium for it, but I've got room to run to the upside. But on my capital requirement, what I have to put up for the trade, it's going to be the premium in that contract, but it's going, you know, it's a way for me to manage my risk. Now, and we calculate that for you on the order ticket up front, so you can see on any call spread or any knockout what it would cost to put on the trade, as well as what your potential reward would be. Now, again, just like binary options, it's important to understand that just because there's an expiration associated with the contract does not mean you have to wait until then to see what happens. Now, with a knockout, if I buy a knockout near a floor, I've got that stop loss, but there could be a lot of room to run to the upside. I might want to put a limit order in up above where I'm not looking for it to go all the way through to the ceiling. I might take a partial profit if it went just halfway to the ceiling. I would be happy with that. I can control my risk reward through limit orders to sell above if I buy, or limit orders to buy below if I sell. Now, with a call spread, this becomes infinitely more important. If I buy a call spread and it's below the, you know, if it's near the floor and it goes down, I know my risk is limited. I bought a call spread, I knew it was limited, but if it goes up through the ceiling, I am still in that trade. So offering a call spread someplace higher if you buy it is something that a lot of traders do, so that if they're not in front of the computer, if they step away and it were to spike up, they would sell it back out, lock in their profits, and move on. You do not have to wait until the end of the week to see what happens, or the end of the contract. It could be a 2-hour contract. It could be a daily contract. It could be a weekly call spread. You do not need to wait till expiration to see what happens. It will settle at expiration, and all the premium will have decayed away to zero. But if you buy a call spread offering it higher, is probably a good way for you to think about locking in profits if it should go your way, because it could always turn around and go south on you, and all your profits would disappear and you missed your opportunity to exit for a profit. Just like if you sold a call spread, you know you're limited. You know you're limited. You can't lose any more than what you put on. You sold it and you knew what it cost to put on the trade. But if it were to go lower and go through the floor, you're still in that trade. For you to close a call spread, you need to buy it back. A short call spread, you need to buy it back. And that's very important to understand, that when you're trading call spreads, closing that position early is something you probably want to consider. Now, you could also close it to limit losses. If I buy a call spread and it just sort of goes nowhere and it's not going higher and it's decaying away, do I have to experience maximum potential loss? No, I could simply sell it, take a partial loss, and move on to another trade. Conversely, if I sold it and it doesn't go anywhere and it starts decaying away and I'm wrong, I could always simply buy it back, minimize my losses. I don't have to experience maximum potential loss. I can lock in profits or minimize losses by closing positions early. I want to thank Nelson, who showed up. I got my my team back. We had Adam early in the day. We got Nelson now answering questions. But again, if you've got more questions about knockouts and call spreads, please email customerservice@nadex.com. I promise you, anyone who put in a question, if we didn't get to it, we're going to have someone follow up with you afterwards. And again, if you want any of these slide decks, please email customerservice@nadex.com and request a copy of the slide decks. You will get them later this week. What I'd like to do now is the off-roading portion. I'd like to show you a demonstration of knockouts and call spreads, how you can see them on the Nadex platform. And what I'm going to have to do here is refresh. Hold on a second. Let's go back here. And what I'm going to do is I'm going to start with knockouts. And let's actually go to an indice. Let's take a look at what's going on in the NASDAQ. I'm going to click any NASDAQ product. I'm going to hide this. The reason it didn't matter which NASDAQ knockout I clicked on. Let's drop this down to 10 minutes. All right, let's expand this a bit. All right, now we can see NASDAQ's obviously been moving around today. The reason I said it doesn't matter which knockout I choose is because on the platform itself, we give you the 4 knockouts, and you can identify them very quickly and easily on what's the floor and what's the ceiling for each knockout. Now, if I thought the NASDAQ were going lower, we're going to roll over from here and head lower. Notice that there's 3 days, they're weekly contracts. Oops. I pushed a wrong button. There we go. There we go. There's 3 hours to go. If I thought this were going lower, I might choose the one with the lowest floor. And if I were, oops, helps if I click on the right contract. Let's do this. There we go. If I were to sell this knockout, all right, my risk is it goes up to the ceiling, 16,333. If I sold this and it went up to the ceiling, I would get knocked out for maximum loss. I'm risking $139. Now, if I sold it and it went all the way down to the floor, my maximum potential profit, $461. Now I can place, I mean, these are pretty tight markets in here, and they are moving around. Look at this. These are 50-cent wide markets. These are pretty tight, liquid markets, 25-cent wide at some point. Very liquid markets. And I can choose whether I want to go long or short. I've got my indicative price up here. And the price of the knockout's going to move in line with the indicative price. Now, if I thought it were going higher, I might choose a different knockout, right? I might choose one with a knockout number 1, which has got the highest floor. And if I were looking to buy this one, let's click there. If I were looking to buy this one, I know that if it were to go down, I know that I couldn't lose any more than $85. Notice for a NASDAQ knockout, the range is $600. right? But it is a way for me to take a very directional trade, and I can choose whether I'm going long or short, and I can manage my risk reward profile based upon which knockout I choose. Now, do I have to trade on these markets? Can I place a bid between the bid-ask spread? Of course I can. If I wanted to buy one in between, I could. If I wanted to sell one in between, I could. But you can control where you want to place your bid-ask, and you can control the risk-reward profile of your knockout, knowing that you've got hard, distinct knockout levels. Now, let's take a look over at call spreads. Now, call spreads are a little different, right? Call spreads are going to have that premium. Here we go. I'm going to go take a look at the indices. Let's take a look at the same ones. Now, notice here I've got every hour. I've got a daily contract. In call spreads, in forex, I've even got weekly contracts. All right. So let's take a look at the euro US dollar. We'll look at the weekly contracts. Here's the weekly call spreads. Now, for me to see what's going on in these markets, I am going to, let's move this to 30 minutes, and let's just see how many. I mean, we've got a lot of different call spreads in here, and the call spread ranges will get highlighted if I click on a call spread. All right, and if I'm buying a call spread, it'll be shaded blue. If I'm selling it, it'll be shaded red. So if I were looking to go short the euro USD, this might be an interesting one. I know I could sell this. I'd be risking 60 to potentially make 190. If it goes up and it went through the ceiling, remember I'm still in the trade, but I'm looking for it to go lower. It gives me some room. You would have to make a determination. I mean, some of these call spreads are a little bit wider. You know, if I wanted to go long, and this is sitting right in the middle of a range. So now here's one where if I wanted to go short on the weekly, it's a smaller contract. Notice, I mean, I could, if I sold this call spread right now, the most I could lose is $6. And what I'm really looking, I'm looking for the euro USD to go down. Now, do I think the euro US dollar is going to go down that low? I don't know. It's a $250, but you know, that might not be what you think is going to happen. But if it were, that might be something you would look at. If you thought the euro US dollar were going to bounce back, you know, what are my options? Here's a call spread where I could risk only $10 to potentially make 240. So if I thought this were going to bounce back, my floor 113.07. Now I'm already below this. I mean, I'm all the way down at 112.57 right now. That's the current indicative price. I mean, it would have to rally up a bit before I even hit the floor of the contract. But it's a way for me to take very little risk. And if I thought this were going to rally back in the next 3 days, right? If we were looking for the euro USD, the euro to show some strength and head higher, here's a limited risk way for me with small amounts of money, you know, looking for an opportunity to profit to the upside. So with knockouts and call spreads, you can see the range of the contract. You can see the floor, you can see the ceiling. Whether you're buying or selling, it'll help you identify it because it'll shade it, and you can identify which call spread. Like if I were looking for it to go lower, maybe this is one that I would want to sell. Right now, it's already in the range a little bit. Right, I could sell this. I mean, I'm risking $60 to potentially. I mean, do I think it's going to go all the way down here? Maybe. You've got to make that determination, but you've got a variety of call spreads. Remember, these are all weekly ones. You're going to have a different set of prices. I mean, the daily ones are going to expire in 12 minutes. So obviously, these ones might not be the ones you're looking for unless you think something were going to happen going into the close, but there would be potential opportunity there. And with knockouts, it's very easy to see what the knockout ranges are. And here I'm going to expand this up a little bit. Let's by looking at the floor and the ceiling, and you can do your technical analysis right from the charts. Let's pick a different chart real quickly here. Let's just take a look at, for instance, the Dow. Let's just bring up the Dow for a second. And if I wanted to do some, I'm just going to make something up here. Over the course of the last few weeks, the Dow has certainly gone down. It's rebounding. If I were to, I'm just making something up, Fibonacci retracement from recent highs to recent lows, drag it over. I could be looking at technical levels. Maybe I think it's going to be some support right here at the 76.4 Fibonacci level. So maybe I want to go long here. I might choose this knockout because it's got the lowest, it's got the highest floor. It's got the highest floor. I know if I were to buy this here because I thought we're going to find some support and go higher, I know that I could potentially, I mean, I'll only be risking $132. Could I put a bid in between the bid-ask spread? Sure. There's, I'm trying to buy one. Oh, look, I bought it right away. It ticked right down. Let's try to buy another one in between the bid-ask spread. I actually want to, no. I was trying to put one between the bid-ask spread, and the spread's so tight I can't even do that right now. But I bought one, and I know. I mean, here's the one that I bought. All right, I paid $35,720 for it. I've already made $3 on it. Great. Could I set my profit target higher? Yeah. I could say I would want to take, $50 out of it. Could I set my profit? I'm going to place a limit order, and I've got an order to sell it higher and take a $50 profit. If it should trade higher and I'm not looking, I'll take a $50 profit. Thank you very much. I know what my losses are, my potential losses. That was baked into when I bought them when I paid 20 for it. I know that I can't lose any more than the 130 I initially put in. So very clear defined risk, very clear defined reward. You can place your orders between the bid-ask spread or away from the market, but it's nice to have those choices, unlike binary options where you're trading that probability and looking for the probability of success. With knockouts, Delta One product, very hard, distinct knockout levels. With call spreads, you've got that optionality in it. But remember, you're not knocked out. You have time for it to go your way. But if it does go your way, you might want to be looking to exit the position early with limit orders in case it were to go your way. And so you can lock in a potential profit before it turned or potentially turned and went against you.